Good morning. Welcome to the Teachers Retirement Board Investment Meeting for December 5th, 2019. I'll start by taking the roll. John Adler.
Here.
Thomas Brown.
Here.
Natalie Green-Giles.
Here.
David Kazansky.
Present.
Russell Buckley.
Here.
Deborah Penny.
Here.
Susanna Vickers.
Here.
We have a quorum.
Okay, great, thank you. And we'll start with Rokitan. Could you give us an update on the passport funds?
Sure. Good morning, everyone.
Good morning, Michael.
So we weren't planning to spend a lot of time on the third quarter performance review, given that we covered that at the last meeting. But the happy to answer any questions on the performance of the passport funds through September. Again, that was something we did review. You'll recall at a very high level, the passport funds, each of them had a, well, I should say that the Diversified Equity Fund posted a modest positive return for the quarter, up about 30 basis points. The Balanced Fund was positive to the tune of about 60 basis points. Where we saw softness in the capital markets, the International Equity Fund had a negative 1.7% return. The Inflation Protection Fund returned 1.3%, and the Socially Responsive Equity Fund, which has since been renamed, as you'll recall, had posted a 2.1% return for the quarter. So happy to dive into that more, but I know we cited some of the more detailed numbers at the last meeting.
Any questions? Yeah, I guess we could.
We'll go ahead to October, and here we saw really positive numbers across the board for markets, which obviously helped with the absolute returns for the various funds. The Diversified Equity Fund had a 2.3% return for the month of October. That brought the year-to-date return to about 20.5%. The 2.3% return was enough to outpace the Russell 3000 for the month, though the hybrid benchmark returned about 2.4%, so lagging the hybrid by about 13 basis points. What drove the results during the month of October, saw strong numbers from U.S. equity markets up a little over 2%. We saw pretty strong results from non-U.S. equity markets, with the MSCI EFI index up about 3.6% and emerging markets up over 4%. So that's really what drove some of the absolute numbers you see on the page. And all told, with respect to the relative results, and also contributing to the overall absolute return of the fund, the defensive composite was up about 1.25% for October, but each of those underlying composites lagged during the month of October. The Balanced Fund had assets of about $400 million at the end of October, had a 1% return for the month, bringing the year-to-date return for that fund to about 8.7%. The International Equity Fund was up about 3.5% compared with its composite or custom benchmark of about 3.7%. The Inflation Protection Fund was up 0.5%, bringing the year-to-date return there to 9.2%. And the Sustainable Equity Fund was up 42 basis points, lagged the Russell 1000 Growth Index, which had a really strong month, up 2.8%. Year-to-date, the Sustainable Equity Fund is up 16.6%.
And this is linked, right?
That's right. The performance you see for the fund, for the Sustainable Equity Fund and its benchmark, is linked to the prior results of the strategy. I actually should note, though, however, the benchmark here in this case is not linked to the S&P 500, which it I think going forward definitely should be, to reflect the prior history of the underlying strategy there. So we'll make that change for the November report.
Okay.
Are there any questions on the October results? So we'll turn ahead then to some preliminary numbers through November. The Russell 3000 index had a really strong month, up 3.8%. International equities across developed and emerging in aggregate were up about 1%. The defensive strategies composite had a really strong month as well, up 3.2%. So we'd expect a return for the Diversified Equity Fund of just north of 3%. And you can see the other underlying strategies and benchmark proxies for the other funds. The Balanced Fund, we'd expect a positive return of about 70 basis points. The EFI index up on its own about over 1%. and emerging markets very modestly negative for the month. But what you can still see across the board is really strong calendar year-to-date returns. And if you look to the second column on this table, pretty strong fiscal year-to-date returns across the board as well. And if there's no questions, that concluded the performance update.
Oh, great. So the emerging markets policy review, do you want to go over that with us?
Sure. So you may recall that at the last investment meeting, we had a discussion about this emerging market company review policy. There was some language that was suggested at that meeting that be added to the policy. So immediately after the last investment meeting, I added that language, which you see in the red text towards the bottom of the page, and circulated it to the board. I did not receive any comments, so would welcome any comments at this point.
Okay, yes, John?
Yeah, so I'm okay with that addition, but I don't think, and I think I expressed this last time, I want us to develop the criteria, agree on the criteria as part of adopting this policy. It doesn't have to be in the policy, but I'm not prepared to vote for the policy until we know what the criteria are. And we've discussed this really a lot, I think, in the course of this process. And we have a proposal for criteria as a jumping off point, but it's up to the board whether that's a discussion you want to have today.
So, if I can jump in. My understanding, and anybody who was at the last investment meeting, correct me if I'm wrong, but my understanding was at that meeting that we did agree that criteria was going to be created, but that it wasn't going to be created at this time, and it wasn't going to be, and the adoption of this policy was not going to be contingent on the criteria being developed first. So I'm, excuse me, I'm fine with this policy as the jumping off point for getting this work started and working on the criteria as we get the data from Sustainalytics and MSCI. But it certainly was my understanding that if there was a mention of the criteria in the policy, that was going to be sufficient for everybody involved to put this in the books and then move forward.
Penny, I just want to, yes, I'm going to echo that was my understanding as well, and I thought the conversation led us to that we couldn't possibly anticipate what all that criteria would look like to put in a policy, so keeping the policy nimble enough to allow us to apply it without knowing the universe of elements that, because it changes as we know from even recent professional development opportunities, there's no way we could know what to put in as every single one possible. I don't want this to be too limiting.
No, I'm agreeing with that. I'm agreeing that I'm just concerned about us not arriving at criteria in a timely way, because timeliness has been my issue with this throughout. Originally, I thought we were going to agree on a policy last summer, then we said it was going to be fall, now we're December, and an implementable policy. This is not an implementable policy until we have criteria.
Well, Suzanne.
I would just add, I sort of agree with what Dave and Natalie has said, and I've articulated this, John, to you before. I think it would be irresponsible for us to develop and approve prescriptive, detailed criteria at this point without having a vendor under contract, which we don't have currently, and without knowing, having a greater understanding of the information that we're going to get and the format that we're going to get it. So the jumping off point policy that you circulated, or that I saw, has very specific thresholds and triggers for action that I'm really uncomfortable with at this point. And I think the best thing to do is to wait until we get feedback from the vendors who can help us develop criteria. And I really like that you are pushing us to do this in a timely way, and I think that that's very helpful. And as soon as we start engaging with the vendor, then we can work to develop criteria. And I think that it says that in this policy that criteria will be developed. But I just don't think it makes any sense whatsoever to try to do it, to put the cart before the horse, and to try to do it before we have that engagement taken care of.
I mean, I think this is all of our feelings. We certainly don't want to kick the can down the road and never do this. But this opens the door so that we can start those discussions, and then we can find out what is actually needed in the policy.
I don't actually understand how this policy right now differs from what we have in place, right? We have an interim policy in place that essentially maintains the excluded companies that were on that list that we got from Sustainalytics and MSCI, right?
Right, in China and Russia.
And Pakistan.
Well, we didn't have Pakistan.
Right. Okay. So that's what's in place. How does adopting this policy change that? Can anybody explain that to me?
I don't think that it's going to make substantive changes right away on the list of excluded companies, but what it does is it codifies a much more detailed and official policy that we have, and it explicitly states that threshold criteria will be developed as the next step. So right now we've done a lot of work, and I mean, that procurement and hiring is not easy when you're a city agency. So we are doing everything that we can. I think that the urgency should be on getting the contract finalized with the vendor. That's what we really need to do to get this going and to have something different in place than we have now. What we don't need to do, I think, in my opinion, is to spend a lot of time on arguing about criteria that it's premature to be looking at.
Question. So there are, I think, 15 or so companies right now that are excluded from our portfolio because they're China, Russia, and they appeared on this list of companies that the two vendors found to be either in violation of the UN Global Compact or had material public controversies. If we adopted this policy today, what happens to that list of 15 companies?
I don't know, maybe.
So, Valerie, do you have a view?
I don't know. I think we would maintain the current.
It says that this policy replaces the interim emerging market review policy, so I don't
But we need,
understand
I'm sorry
that.
to keep interrupting, harping on this, but in order to take any action, we need to review information provided by third-party vendors.
Okay.
So I think the interim policy, the interim situation will stay in effect until we have a report from the third-party vendor, and then we start using this policy.
But
So-
the interim policy is based on the report, the interim report we got from the third-party vendor.
That's not
Well,
I would not say, I think that was practice,
It
that.
was kind of a practical decision. We didn't want to permit the managers to buy these securities if 3 months later we were going to tell them to sell this security.
But I don't see
And I would
how-
actually say you could do it either way. You could maintain those companies as excluded, or you could unless they're subject to a separate divestment, and some of them were, you could lift those distinctions. I don't even recall, because I think some of them fell down on the list. I don't know that they were like your red companies.
But I don't know if I'm looking at this from a totally different perspective as everybody else, but, you know, we have not engaged the vendor. We do not have a report or information officially provided by that vendor. We have a sales pitch from vendors. We have kind of initial draft information from that vendor and another vendor. We have not gone through the process that we've all agreed we need to go through to responsibly review these companies. So that has not happened yet. So I don't see how we can develop criteria for something that hasn't happened yet. And I say again that we are trying to officially hire the third-party vendor and figure out the vendor that the MSCI system that we have, how that can be utilized. This board has not acted on those two things. So I think it's important to have this policy and to develop the criteria, but we can't have criteria holding this up now.
I hear that, but what is stopping us from hiring the vendor?
Nothing is stopping us. It's a lengthy, as you know.
But this is a small procurement. This is not a full RFP based on the price. That's
So what are you
$100,000 or
saying?
less. I'm saying that I make a motion to hire Sustainalytics if that hasn't happened yet.
No, that has happened, but what has not happened is that the contract has not been finalized. I am not a procurement person. I do not work in the controller's contracting unit, but I can find out what the status of that contract is. But, you know, for anybody sitting around this table to act like it's a surprise that the city of New York process is lengthy, bureaucratic, and slow
But, you know,
is not a fair statement.
I get that. But here's the thing. It's not clear, and maybe we can make it clear today, that this policy does not mean that we open the floodgates and allow investments in every company, since we have not yet developed criteria. We did, I mean, just to be clear, we took investment decisions based on the data that we received from those two vendors, right? We made investment decisions based on that.
We created an interim policy.
So I would like, so what I'm saying is I don't want to move from that interim policy until we put new criteria in place that stipulates look, the point of this process, right, which we've been engaged in for a couple of years, I think, is to replace our country screens that have been in place for 10 or more years with company screening, so that we do not invest in companies that we believe pose undue risks to the teachers' retirement system. I believe that we are currently investing in such companies, and those companies appear on the list that we got from MSCI and Sustainalytics. And I am concerned that adopting this policy without either a set of criteria or a strict timeline for adopting a set of criteria puts the system at risk by investing in companies that I do not believe the members of the system would like to see this board invested in, and that pose undue financial and reputational risks to the board. So I'm saying that on the record, that I'm worried that that is what's happening, and that this is taking much more time than we anticipated it would take. And so I'm worried about adopting a policy without putting those criteria in place underlying the policy. Obviously, the criteria will change over time. But right now, there's no process in place for adopting those criteria, and that's what worries me.
Okay, so can I just respond to that? And so I think that, that maybe you're conflating several different processes that, and trying to take care of everything today. So I would suggest, you sort of gave two options in what you just said. I would suggest a third, that we adopt this policy as written today, and in the motion of adoption, we say that the interim policy remains in effect until we, until the vendor is hired and
Criteria.
criteria developed, and the first annual report is delivered and criteria is developed. So that should protect us from opening the floodgates to investments in dangerous companies.
Yeah, I know, I don't think the intent was to invest in those 15 companies concurrent with the passage of, or the everyone approving this, because I think we all felt like there was a reasonable chance that whatever criteria we came up with, regardless of how severe or not that criteria would be, that there was a relatively high likelihood that those 15 companies might be on that list. So I think we recognize, for the same reasons we continue to not invest in them, we wouldn't all of a sudden start investing with them now just because we approve this, and then we would choose to divest later. So I just think from a practical standpoint, I don't think anyone was considering allowing investment in those 15 companies just because we approved this. I still think we recognize we need to finalize the criteria before we change what we're investing in.
Right, I don't think again, this was not intended to open the floodgates, because that's one thing that we spoke about a while ago, that we did not want to open the floodgates, but it was just to start the discussion, and we had for so long that policy where we didn't invest in China, Russia, Pakistan, and then we would do, well, okay, it's okay for this, in this case, and that's how we started this. We were very uncomfortable for making those exceptions without having something in writing, and without having some system where we could actually check and see, why don't we invest in those companies. Valerie, what do you feel about this? Is this something that's necessary for us to do the work?
I think it guides the work. I don't think it stops what John wants to ultimately arrive at. The policy itself talks about a review, and maybe you could put a time frame there.
I'd like
which
to
would
put
bring
a
it
time
back
frame.
to the board. And I mean, my understanding was you wanted to first have at least one report from the vendors, and that would inform your development of criteria.
I mean,
so that would be.
The reality is, we did get a report from the vendor, which is what has been.
I don't
think we can I finish?
No, I'm going to interrupt, because I would say.
Madam Chair, could I finish my point?
But I would say, if
I guess not.
BAM came to you with unofficial, draft information from some vendor that was trying to sell us something, and we based an investment recommendation on that.
Excuse me, the interim policy is based on that.
It's an interim policy.
Exactly.
But I just can't believe that you are suggesting that we adopt criteria based on unofficial information from a vendor who was trying to sell us something and is not under contract. That is a very dangerous thing that you're suggesting.
But honestly, we made an investment decision. We created an interim emerging markets policy and allowed investments in companies based on that a flimsy report from a vendor who's trying to sell it.
So I don't think that.
I mean, that's what you're saying. I don't agree that that's what it was.
No, we let that inform a decision to change a policy that we all agree.
A company that didn't appear on their list, we opened for investment.
All right, so David, do you want to?
So my belief is that the interim policy was put into place just because of what we're dealing with right now, which was no matter the best intentions of this group, that it was going to take much longer than expected to be able to put together a policy that was going to be good and long-term. So we created an interim policy at that particular moment in time to get us from point A, which was where we had our old policy in place, where a huge part of the international market was completely cut off to us, to where we want to be, right, as a more reasonable, rational fiduciary, right? And so at that moment in time, with the best information that we had at that moment in time, we crafted that bridge to get us from point A to point B. So flimsy, I perhaps, but it was the best information that we had at the time, right? And we gave us the ability to put together some plan to get from where we were to where we want to be. I have no problem with that interim policy. And it didn't preclude us, if we didn't use any of that data, we probably would still be cut off from investing specifically in China, which was really the main focus of the change in policy. We should keep that interim policy in place with this overlaying it until BAM gets the contracting done. The second BAM gets the contracting done, we should be moving on getting information from those vendors and putting criteria together. This policy allows us to make that happen. That's the next step to get off of the bridge that we're on right now and into where we need to be.
I'd like to, as Valerie suggested, set a time frame for doing that.
I think that I would not agree that in this policy, because I think this policy should be
in the motion.
Okay, thank you.
All right, so what would it be a fair? So we do have something about the policy is going to be reviewed no later than 18 to 24 months from adoption. So we want something, do we want to keep that and just make it so that it's going to be reviewed sooner than that?
No, that's for the policy. I
You
want
want to keep this time frame for that? So what would be a fair timeline? What could?
I think the timeline has to be linked to the registration of the contract. We can't say, this criteria has to be developed in 4 weeks, and then the contract isn't done, then we're just back to where we are. So I would say within a certain amount of time after the registration of the contract.
And I would just point out, and delivery of the reports to the board.
Yes.
But I'm sorry, I'm not going to agree to something with an open-ended thing like that.
So put a date in, but we're saying that it has to, the start date has to be once that the vendor is hired and that the reports have been delivered.
So why don't you come back to us with concrete information about what the timeline is for that, and then we'll approve the.
Well, you don't know when you're going to finish with the. So if the vendor is hired, so from whatever date the vendor is hired,
Right.
do we want to come back for
Well, for example, I'm sorry to interrupt. We might need to know from the vendor how long it takes them to do their report.
I didn't get the sense that it would take very long, but that's fine. So here's my suggestion. Why don't we ask BAM to come back to us with the answers to those questions. How long is it going to take to register the contract? And then from Sustainalytics, who's coming in today, but I think it's a different part of Sustainalytics.
Yes.
How long would it take them, once the contract is registered, to generate the annual report? And then based on that, we can set a timeline, and I would propose that we vote on the motion when we have that information.
or can we ask them for the next available report once we hire them? Certainly ask them
Why
when.
can't we just pick a period of time after they deliver the report and tell them we want the report as soon as possible? Maybe we could resolve that now.
Right, because those two dates shouldn't preclude us from passing the resolution.
So you could say something like within 90 days after the delivery of the first report? Does that seem reasonable?
Sure, that's fine.
All right, so we would, well, we have to take consensus, right? It's not an exact vote, it's a consensus if we want to agree to the policy. And then do we put the stipulation that once the vendor is hired,
Days.
within 90 days
After the delivery of.
after the delivery of the report?
The criteria will be developed.
Well, the proposed criteria will be presented to the board for discussion and review. How about that?
And this is consensus, not a vote?
There would be consensus as a policy that it actually comes back to
recommendation to
the
the-
full board.
recommendation to
It
the
comes
board.
back to the board.
So we're gonna take consensus about it coming back to the board, next board meeting, knowing that,
It will
Wait.
come to the December board meeting, the policy.
okay, and once the vendor is hired, then we're going to come back 90 days after the report is given? Okay,
Are you gonna
Within
find,
90.
within 90 days.
and are you going to find out the timeline for registering the contract, Susanna?
Yes, I don't know if I'll get an exact date, but I will inquire.
But you'll get us. Okay, and this will at least start us. So do we have consensus for going ahead with this and bringing this before the board?
Yes.
And just one other point, that it also includes keeping the interim exclusion list in place until such time as we arrive at a criteria for a new analysis.
Correct. Do we all understand that and agree upon that?
Yes.
Okay, then we have consensus? Yep. All right, great. Okay. And now on a lighter note.
Well, you don't know that yet.
Just trying to manage expectations.
Okay, let's discuss the asset allocation.
So I'm going to introduce this topic, but this is very much a collaboration between BAM and Rokutan, and we've been hard at work at this for many months now. And I'd like to present this, I'd like the board to consider this report in as one in a series of pieces that have been presented for the board's consideration on this topic. So for the past number of months, BAM and Rokutan have been presenting at the SIM, at caucus, at the investment meeting on market conditions and the themes that have been developing as we look at capital markets and we consider potential modification to the pension fund's asset allocation policy. So literally none of the recommendation or the market information that you see in this report is new. This has been presented in a variety of venues, but what we're attempting to do today is to pull together the market, capital market information that informs the development of the themes that then were used in the modeling of various portfolio mixes. I also want to emphasize a point that's made in this lengthy deck, which is that we are not presenting this for a vote. There are certainly more than one portfolio mixes that could be considered as appropriate and consistent with the capital market themes that BAM and Rokutan have been developing. This is one policy that we thought was worthy of the board's consideration, but we fully expect and welcome the board's input, questions, feedback, so that we can come back to you in response to those questions. This is a critically important topic, and one that we would imagine will take several more discussions before the board is at a point where it can comfortably vote on this topic. So I apologize that you only got this on Tuesday, but again, this date, none of the data in here is new, but it is a lengthy document and it is an important discussion. So what we're going to do next is have Mike Haddad present, as he has done in the past, the capital market information and themes that again were an important basis of the recommendation. And then Joe Nancroft, who is head of asset allocation at Rokutan and who I think you've all met before, will walk through the process by which we came to the recommendation, which again, you saw at the SIP caucus. Mike?
Mike, just want to
Well, did you have a question?
Okay,
for the record.
yes, and Alex Dunier, our CEO, is on the phone as well. So let's.
Good morning, everybody.
Oh, good morning.
So we have 39 slides in 45 minutes, so we got to go slide a minute. So let's jump to slide 4, capital market conditions. And as Robin had laid out, there's nothing new here that you haven't either heard from me or Rokotan before, and why it's so important in coming up with what the right recommendation is. And you have to take into account where markets are, where valuations are, and that's a function of what's happened over the past several years. So that's an important backdrop to think about. And as we think about the U.S. equity market, which is your largest single allocation currently and will remain your largest single allocation, do we want to increase that, decrease that, leave that the same? And then also important is the role of fixed income within this. And as we're all aware, the U.S. equity market is an all-time high. Based upon both earnings and multiple expansion. And that multiple expansion also has something to do with interest rates. Very simply thinking about it, the lower the interest rate, that's the discount rate you use on a series of cash flows. So all things being equal, lower interest rates are more supportive for the economy. So it's important to bear in mind that the low interest rates have been a headwind, have been a tailwind for the equity market and for your portfolio over the past few years. So that's kind of the backdrop of where we sit. If we flip over to slide 5, again, you've seen this before. This is your current asset classes, your actual, the teacher's returns 3 and 5 years, and then the change in Rokotan's expected returns in 2016 when we did this and where we sit today. And again, I would highlight on actual returns, where the outliers have really been. The U.S. equity market has massively outperformed expectations. Real estate, we have, our portfolios have outperformed. Again, a function of both, I'm going to give the real estate team a shout out, manager selection, as well as the falling interest rates. Again, private equity has outperformed expectations. Again, a lot has to do with manager selection. And infrastructure's done well as well. And we think there's some differentiated approaches to how we go about doing that, but they're important to look at as we think about going forward. Again, I don't want to belabor somebody. If we switch over to slide 6, you've seen this before. This slide was as of August of 19. So if we updated this, that top bar on the left would show 125 months now, not 122, and that trend line below would continue. And importantly, I would say expectations going forward are for continuation of this slide. That is continued expansion in the U.S. of something 1.5% to 2%. No recession in sight as of yet. Really, no flashing signs other than the longest recovery in history. But it's also been a very slow recovery, and that kind of sets the stage for how we think about markets going forward. Slide 7, that's that Bridgewater slide. No need to go over that again. We go to slide 8. Again, a valuation slide on the relative expensiveness of the U.S. equity market. As you can see in the source there, this is as of August of 2019. Whether this is clicked over to the 10th decile or not is the question. It's either the 9th or the 10th decile. Again, highlighting. If you believe in this valuation technique, that the expected returns on U.S. equities going forward are going to be lower than what we've experienced in the past few years. Slide 9, again, a short snapshot of the history of interest rates in the history of our country. And again, if we continued all the way out, in August of this year, we were sub 2%. So if we took out the lows that we had in the World War II environment, of interest rates in the U.S. We're back up to around 220 now, so not much of a backup, but on a historical perspective, I think this chart explains a lot. And if we go to slide 10 and 11, again, you've seen these before. This speaks to private market valuations, and on slide 10 is private equity. Again, very high purchase price multiples. not unexpected given the PE multiples in the equity market. So this is kind of a similar looking chart, but it speaks to private equity. Slide 11, cap rates are what you think about for return expectations in core real estate, and they follow the 10-year note yield with some deviation in spread, and as you can see, we're at or near all-time lows in cap rates in U.S. In the U.S. as well, so the expectations on core real estate have to be lower than what they were previously. And then if we switch over to 12, this gets into one of the largest constraints that we all have to deal with, and it's the basket clause. And just a reminder, what goes in the basket? 100% of private equity, 100% of alternative credit. The other asset class that's 100% is hedge funds, not in your portfolio, not germane. But the other ones where there's thresholds are international equities, so both developed market and emerging markets, greater than 10% fall into the basket. Real assets, defined as real estate plus infrastructure, over 10% into your basket. High yield, over 10% into the basket. That total basket size is constrained to 25% of your portfolio. So if we were to run an efficient frontier and a recommendation without that basket clause, it would not look like what you're going to see in a few slides from Robin. It is what it is. There's a lot of effort being done on this, and my expectation is we're going to ask for your help as well. So it's just a precursor on what may be coming your direction.
Thanks for the plug.
And I'm going to turn it over to you, Robin.
Okay. Do you want to talk about that page, or do you want us to? It's a busy page. So, let me jump in.
Which page?
Say page 13.
13.
It's a busy page, but it's important because if you run an optimizer without any constraints, it produces portfolios that are not investable. So an optimizer is just, when Joe is going to wince as I describe what an optimizer is, but it's just a box that takes in a lot of inputs, and so it takes in volatility expectations, it takes in expected return expectations, it takes in correlation assumptions. And out of that, it tries to produce the portfolio with the highest level of return for a given level of risk, and that's the efficient frontier. But it also it can't incorporate qualitative and judgmental factors that are really important in building a portfolio. That's where humans come in. And so we put into place these constraints. So the basket constraint is just an arbitrary constraint that we're forced to employ. We put that in the modeling process. But there are other constraints that limit the portfolio mixes that come out of the modeling process, because after doing this thousands of times, literally, we know that you're going to get portfolio mixes that aren't pragmatic, that aren't investable, that we would never consider. So there are, for example, here we say we're only going to consider core real estate in the range of 3 to 7%, because we know that we don't want to sell off a lot of real estate. We know that we have trouble getting fully invested in real estate because of the scale that we have to work at. And so there are all these pragmatic constraints that we put onto the optimization process. And I'm happy to go through any one of them.
Just another good one that to reference, which is something that we incorporate in just about any asset allocation study we're working on, regardless of the portfolio type, would be illiquids. So in this case, we say we want all illiquids, all the illiquid asset classes, to not represent more than 25% of the portfolio, because illiquids generally have higher returns than liquid asset classes, for good reason. But the optimizer might see that and say, let me take more illiquids than would be reasonable to have in a portfolio. And I think you could ask some of the largest university endowments what it was like to have 40 or 50 or 60% illiquids during the financial crisis. They got caught with too much illiquid exposure across their portfolios in many cases, and we've tried to avoid that for all of our history with our clients, because we know that it's hard to, and I'm sure you all know, it's hard to navigate the exact right amount to allocate to illiquids in any given year. It's a long-term game, and I think in this case we want to make sure that we have a reasonable amount they're attractive, but they're attractive to a point. So and again, we can go through any one of these line items, but those are just some examples of what we try to incorporate to make the output of the optimizer reasonable, something that we look at and say, yes, this is a portfolio we think is a reasonable portfolio for an institutional investor to invest in.
And we can, and just one last thought is, we can modify any of these constraints. So you might come back to us and say, what would happen if you relaxed this constraint, or added a constraint, or eliminated a constraint? And we can tell you what the impact on the recommendation or the output would be.
I
question?
I have a question that what's the rationale for the one that says non-investment grade fixed income is less than or equal to 12%? What's the rationale for that one? And it includes 50% of OFI. Why 50% of OFI? I just don't understand where that comes from.
Yeah, in this case, we're just grouping like asset classes and saying that that these in combination, we would not want to represent more than a certain percentage of the portfolio. So we're just trying to recognize that these are similar in some ways. That they offer spreads above investment grade asset classes. They have some that they're semi-liquid or semi-illiquid, either way you want to look at it. And given those factors, we're trying to consider them as a group and limit the amount of exposure. So what's the logic for 12 versus 15 versus 20 versus 8?
And what's the logic for 50%?
So 50% of our, that was a ballpark to represent below investment grade, less liquid portion of OFI, because it's not all illiquid.
Really?
Yeah.
Huh. Okay. It's all the basket, right?
Yes.
Yeah.
Why is some of it not illiquid?
For the same reason, like bank loans, I think 90 to 100% of bank loans go in the basket, but there is, you do have some liquidity with bank loans. It just costs a lot more to transact in those markets.
But OFI is all in either separate accounts or limited partnerships. I just don't understand why 50% of it would be liquid.
We'll come back to you with more detail
Thanks.
on that.
Any other questions or comments on the constraints?
Yeah, just one, the private equity. Is that, it's greater than or equal to 6%?
Yeah, that's correct. Very good eye. We're at 6% today. That was the logic for that.
Right.
We don't, if and given what we discussed earlier about illiquids only representing
Less than 25.
25% or less, and the fact that private equity return expectations are tied very much to the U.S. market, which means that they're low relative to what would be we'd consider to be normal. The optimizer could look at that and say, we want less private equity given the group constraint we put on the illiquids. And we said, well, that's all well and good if we wanted less private equity, but we have 6% already, so we wanted to be realistic about it.
Okay.
And let me add a little bit, because this is one that evolved through our many discussions over the months. We started with a constraint of plus or minus 2% on private equity for the reasons Robin articulated. We didn't want to go down too hard because selling it, there's a transaction cost involved. We didn't want to increase too much because it's hard to get the money to work in a reasonable amount of time, and you don't want vintage risk. So then, if I recall, the optimizer came out with a 5% recommendation at one point. And then one of the lenses we at BAM have are seeing 5 different consultants' capital markets assumptions, and Rokutan is an outlier on the low side for U.S. equities and for private equity. So within that, we didn't think it, we don't want to challenge them on their capital markets assumptions, but we want to say you are an outlier, and and the returns that we have had relative to their previous recommendation were 2 or 3x that. So let's not decrease this. Let's at least hold it equal. And if you don't want any more, that's one thing. So this is kind of one that we, I think, negotiated on. But then, to Robin's point, we're happy to go back with iterations if you guys want more or less, and to show you what that looks like.
Wait, I understand you don't want to challenge them on their capital markets assumptions, but I don't think we're under such a limitation. When is the appropriate time to have that discussion?
Well, I think, so I think.
It may not be right now.
It could be, but I think rather than saying to us, well, I think the right number is 7
I'm
rather
not
than
gonna say
4.
that.
No, but I think it could be, if I were inclined, and we internally, we do challenge, because we've lived with this for a long time, and we will be right at some point. But I do think it's reasonable for the board to say, what if you were more in line on your equity assumptions on your U.S. equity assumption? I don't think we're so far off on non-U.S. or emerging.
I think that's right.
But what if your U.S. equity and private market equity assumption was more in line with other consultants? How would that affect this recommendation? So rather than debate what the right number is, I think
I don't want
that's,
to debate
yeah,
what the right number,
yeah.
I just want to understand some things.
Yeah.
Like, just one example.
Yeah.
This may not be the right time to do it, but comparing 2016 to 2019, your premium for private equity over U.S. equity went from 100 basis points to 330 basis points. So last time 4.6 to 5.6, this time 3.4 to 6.7. That's pretty shocking. Could you just explain that one?
Sure.
I mean, there's other ones that are surprising, but that one's just like, I can't wrap my head around
Private equity.
John, where are you looking at that?
I'm looking at page 5 at the capital markets expectations, so the third and fourth columns. And you see in June 2016, Rocaton had a capital markets expectation of 4.6 for US equity, and private equity 100 basis point spread, 5.6. And today is 3.4, so it's, you know, more than 200 basis points lower, but they increased the private equity by 100 basis points, so the total difference is over 300. So how do you get from 100 to 300 spread?
During that 3-year period, we've changed the methodology. I said change is maybe too strong a term. Modified the methodology for private equity modeling to loosen the tie. It's still tied to U.S. equity, but it's loosened the tie to the U.S. equity, the current valuation in U.S. equity markets, and U.S. equity return expectation over the next 5 or 10 year horizon. So, and that's with recognition of what we've seen how clients are investing in private equity, which is, yes, there's a lot that is very much equity linked in private equity portfolios, but there's other things that are less equity linked, like credit, or it could be kind of just different types of strategies that are not, strictly buyouts or.
To be more focused in them as part of
That,
smaller
we don't do that in
LBOs.
private equity, we do it in OFI. We don't do debt investing.
Yes, John, but I would add that in private equity, there is a bias, at this part of the market cycle for us to invest in strategies that are, let's call it special situations, as we've mentioned in the recent annual plan, and things that are more value, credit oriented, et cetera.
And we understand there are different flavors of credit. Some that are more liquid or semi-liquid, which are probably in your OFI portfolio, definitely in the OFI portfolio. But then there are other less liquid credit strategies, which are in limited partnerships, which belong more that are in drawdown structures that belong and end up in private equity portfolios. Again, like you're doing. So I think there's just been a recognition we've seen with our clients' results that the private equity allocations are not behaving as closely to U.S. equity markets as we had originally thought. There's the other piece to it is there's a global piece to it as well. So there's some non-U.S. exposure in private equity portfolios, and you can see, and we've recognized that more explicitly in our forecast going forward as well, because if we're just tied to U.S., yes, the return expectations are much more closely tied to the U.S. equity market, but private equity portfolios in general do have non-U.S. exposure, and you can see there's growing disparity between U.S. and non-U.S. forecasts in our forecasts as well.
Alex, how much non-U.S. exposure do we have in our private equity portfolio?
I want to say it's about 20+%. plus or minus percent in aggregate. I don't know teachers' numbers specifically, but it's in that neighborhood.
That seems high. Yeah, that seems high. I don't really think we have 20% international, but we can check.
On an NAV basis, you do.
Just want to highlight, historically, if you look at the past 3 years, private
That's
equity,
Steve you want. Yeah.
15.9 versus 14.3, so private equity outperformed by 160 basis points.
It's been a tremendous.
I couldn't hear that comment.
Yeah.
Could you speak up, Steve?
You have to come closer to the table.
Sure. So I'll just comment on the historical performance. Private equity outperformed U.S. equity by 160 basis points versus our current forecast of 330 basis points.
Thank you.
Anyway, we can come back on the whole capital markets assumptions. That was just one that
Of course.
stuck out at me. So let me not interrupt your
Of course.
any further.
Well, please keep interrupting with any questions or
better not
anything.
say that.
Well,
Be careful now.
Now you've got it.
okay, all
Make me use this.
right. So on page 14, we do have and we've already discussed some of this. I think the message I wanted to leave you with on this page is what you can see is if you look across the 5, 10, and 30-year assumptions for just about every asset class, the next 5 years is below the next 10 years, and the next 10 years is below the next 30 years. And that's a function of everything that Mike Adag went through a few minutes ago: low rates, low spreads, and higher equity market valuations, mostly in the U.S., less so outside the U.S., as I think we already discussed. And I think those are the key things, the key message I want to leave you with on page 14. On page 15, I would refer to this as a bit of a scorecard across all the asset classes, trying to measure them I'd say in loose terms across a number of metrics that are important when you consider how an asset class fits into a portfolio. So things like, and again, we've talked about this already, what the valuation is, where are they relative to history trading. And you can see that's not a pretty picture, that generally things are expensive or moderately priced relative to history. Then returns, of course, are how they contribute to returns to a portfolio. And then diversification properties is another one that I want to highlight. And you can see in the middle of the column, going down the column, you can see treasuries, mortgages, and credit generally offer the greatest diversification properties. And when we say diversification, that's relative to equity risk in a portfolio. And you can see U.S. equity has low diversification relative to itself, of course. We've already talked about liquidity, and we'll talk about the target allocations. And then the basket clause we've already discussed. We've created a checklist here of how they contribute to the basket as well.
But just to highlight this page, these are the trade-offs that are involved in optimization. This is all we have. We have these criteria. We're trying to put together a basket, a portfolio that isn't dramatically different from the portfolio you have today, because we're not going to change 50% of the portfolio. But we're trying to identify, based on these trade-offs, what relatively modest changes would enhance outcomes over the next 5 to 7 years.
And this is a way to just provide a visual and just again a bit of a scorecard, which is what really the optimizer is taking into consideration. So when you think about the optimizer, as Robin put it earlier, I didn't wince at all. It's just a mathematical formula which is solving, given all these inputs, it's solving for what the best risk-adjusted return portfolio is across the risk curve. And we'll look at the visual in a minute of what the optimizer gave us. On pages 16 and 17, and I'm looking at these together if everyone else can do the same. We have the current actual asset allocation for the portfolio as of September 30. And you can see here, it's about 50% in public equity. There's a variety of other illiquid asset classes: real estate, private equity, infrastructure, real assets. And then we have total investment grade fixed income I'll have you focus on, which is about 23%. And then again, we've got, I'll call them credit-oriented asset classes, high-yield bank loans, convertibles, and then tips of 4%. And OFIs at the bottom of almost 3%. If you just slide your eye over to the right, you can see the policy target. We're very close on public equity. We are above our target in investment grade fixed income. That is a function of placeholders, which we'll talk about in a minute, for asset classes, which we have targets to, but we're not funded at that level yet. And I think everyone's familiar with how we've treated unfunded targeted commitments to private assets, and that falls into investment grade fixed income to a great extent. Not entirely. That's not the only thing that's driving that, but that's mostly what's driving that. If you look at the recommended targets, the most notable change, and we'll talk in a minute about why, and I think we've already covered a lot of this, is to reduce public equity by 7% roughly, and increase commensurately investment grade fixed income by 8%. There are a number of other, I'll say, much smaller changes. That's the main, that's the primary change that I think is worth discussing today. Discuss anything else you'd like. I think the motivation for this, as represented by the optimizer, but again, we've talked about a lot of the rationale, is on page 17. And the way I would really characterize this curve, again, this is what the optimizer, the red line.
You should describe what an efficient frontier is.
Sure. So the red line and the efficient frontier is just the given all the inputs we've talked about, the returns, the risks, how correlated the asset classes are with one another. The optimizer asks the following question: what is the mix of assets at every risk level that gives me the best return? Okay, so the optimizer says there is no better return I can get than if you look at a 10% risk portfolio. If you just slide your eye up, I can't get better than 6.2%. That's what it's telling us, compound. And there's a mix of assets which gets us that. Now, this curve, and we've looked at this, as Robin said, thousands of times, not just 1,000, thousands of times over the years. This curve is extraordinarily flat today, meaning that as you move from left to right and take on more risk, you're getting less and less return. You get some incremental return to a point, but we've lived through periods, if you go back to 2009, the US equity market, as another data point, has generated more than 13% annualized returns over the last 10 years from the bottom in 2009. That's over 13% annualized for 10 years. That's an extraordinary return. That's almost double per year what we expect over the very long term, which is about 7%. So we've enjoyed a fantastic period in history for the last 10 years being an investor, but I think our assumptions recognize it will be difficult to reproduce that for the next 5 or 10 years. And that's what this curve is really a function of. It's saying if US equity is a big part of our portfolio, we can't get much more return as we continue to increase risk. So we're saying, well, if we're not getting a lot more return per unit of risk when we go out on the curve, maybe it's a good time to ratchet back risk a little bit and take money out of US equity particularly, and put money in fixed income, which is a more defensive place to be for the near term. And when I say near term, more medium term. We're not making this decision and expecting to make a change in 6 or 12 months. It's really, we should think about any strategic change to be a minimum of 3 years. Not to say we won't review this between now and then, but we want to be willing to live with this decision, any decision we make, when we make the decision, which is not today, for 3 years or more. We have plotted the policy targets, the policy target and what we're intending to recommend at some future meeting for consideration. But again, we're looking for input and questions today. And what you can see, looking back at page 16, is that for the next 5 years, well, I'd say for the next 5, 10, or 30 years, we're bringing the risk down from about 11% to about 10%. So we're reducing risk by about 10%. So 1% reduction on 11% start. So it's a meaningful reduction in risk. And then we're sacrificing almost no return over any of the time horizons we're looking at. For the next 5 years, we'd say they're about equivalent from a return standpoint. And for the next 10 years, we'd say it's about a 10 basis point, 6.2 versus 6.1% return expectation. So we think risk-adjusted return is improved, risk is lower, return is about the same for the next 10 years. And we'd also say if you kept these portfolios for the next 30 years, the expectation is that you would get a 7% or more return for the next 30 years with either portfolio. Of course, that's not the way things work. We don't just put a portfolio in a drawer for 30 years and come back 30 years later. We're going to be looking at this obviously on a regular basis over all that time. Any questions? Okay.
Yeah, I mean, I don't know if now is the best time to sort of discuss the last thing that you said about, where we are right now, which is discussing a portfolio that is significantly below our targeted return. And, sort of how the board feels about that.
One part of the response would be, so the targeted return, I'll say actuarially, is a very, very long run expectation. And I'd probably look at it more relative to the 30-year expectations. Now, I would say as a function of our forecasts or capital market assumptions, and if you look at this efficient frontier, we're saying this efficient frontier is based on the next 10 years.
Right.
There is not a portfolio with our assumptions that can generate 7% for the next 10 years.
And our constraints.
Right.
And the constraints, yes.
Right. Understood, but, the actuary is here, and, I don't know, I don't think that the implications of, less than 7% are kind of, there's a shorter term impact than 30 years, is what I'm trying to get at. And
I will say that when you look at a portfolio, I know that the 30-year is above 7%, the expected return. But when you look at the liability and you weight it on a present value basis, the first 10 years has a lot heavier weight than a 30-year horizon. So there should be, even though, pensions, obviously liabilities is a long-term investment, horizon, you should be putting more weight in the first 10 years.
From a planning perspective.
From just a pure present value perspective, because cash flows down the road, once they're discounted so many years down, they don't have as high of an effect as the first 10 years. Because your money is, closer to, you need to plan for the next 10 years more than you need to plan.
So that over 7% return is worth less the farther out you go.
Right.
So I understand, sort of what you're saying and what Bam has said, that there's nothing on this line that gets us even close to where we need to be. So I don't know how to address that, but it is an issue that I'd like to, kind of discuss more and just maybe think about, any stone unturned, is there anything that we can do to kind of even get incremental increases?
So one thing I will say is that, although we haven't explicitly noted it here, our assumptions are all beta assumptions, passive assumptions. And you can't, so we're trying to say in the broad asset class and this is particularly relevant for private markets, the broad asset class within private markets, this is what we think the universe of opportunities will generate.
Right.
Now your investments in private markets have done much better than the universe of opportunities.
Right.
So I think there is, these numbers do not reflect the incremental returns we would anticipate that you'd earn in your private equity, private real estate, and infrastructure portfolios.
And
That's
how,
true of the capital markets. I mean, I know it's supposed to be true,
Yes.
but I, again, was questioning some of the private markets assumptions, given these larger spreads. They don't take into account active
We don't,
management.
we don't assume skill. Seriously.
but is there,
Ouch.
is there
That's
ever,
all our
But maybe
active-
we should, in your
all our
case.
active
Right, but-
managers watching.
right, because, sort of, we're being asked to make decisions based on the lowest common denominator.
Yeah.
Just sort of the average general return for each of these things. And I don't know if there's a way, to bake in some of those other assumptions, or the assumptions that you're not making.
And we have for clients, added, active management premiums across asset classes to approximate what the actual portfolio's expectation is with the market plus active management net of fees. So we've done that, and we have standard assumptions, which is not to say that we have never customized them for clients, but we do have assumptions across asset classes which attempt to estimate what that might be, what skill could generate.
So for private markets, I'll use private equity as an example. If we have the ability and to hire and only managers in the top 2 quartiles, would it make sense to use return assumptions based on the top of the spectrum rather than the entire spectrum of managers?
Yeah, I think that is the type of thing that we can absolutely do. We can add those premiums. Typically, the way we would do it is we optimize the way we've done already. So the process that we've tried to illustrate for you today and describe to you today, it would be identical, and then we'd say, well, given the asset allocation that we are recommending and the premiums we believe you can attain across each of the asset classes, what would the portfolio level premium be that we would add to the 6.2% or whatever the number is for the next 10 years. And that would just give you a sense of, can we get you to the 7% given this asset allocation and the skill that you think you're deploying across the portfolio or accessing.
It strikes me that, and you mentioned this before, Robin, the crucial determinant here is your U.S. equity assumption, which is, as you said, it's way below all the other assumptions we see from all the other consultants and from the market as a whole. So what would this look like if you were to use more of a consensus U.S. equity assumption? You had suggested
Yeah, we can look at that, yes,
I would
absolutely.
ask to look at that, whether it's the other New York City consultants or the investment, whatever it is, that's out there as a more consensus. Because I think the consensus, Mike, what would be the consensus U.S. equity?
Call it 6.
What's that?
6.
6. I mean,
That's a big difference.
it's a huge difference. And it seems to me that if we, obviously, even if we just took your thing with a 6% equity allocation, you're looking at a much higher expected return. Now, it's going to, obviously, doing that, you would change everything else as well. But that 3.4 is such a killer, truthfully, in terms of expected return.
Yep.
I mean, to follow John's point, I do have like 2 slides. Maybe if you make you distribute over this side, just to follow up that discussion.
Thank you.
Yeah, so what is this that we're giving out?
Oh, I was just having a view about the U.S. equity return.
Yes.
And I would ask if you have anything in the future prepared, if you would
sure.
give it to us ahead of time so we know what we're exactly looking at.
Yeah, we just talked about it late yesterday, so
Yeah,
I
and so,
apologize. And by the way, I mean, we only got Robin's thing yesterday, so, it was hard to
Well, we've had this for a while, right? And so in the interest of time,
Robin's,
also.
Well, the recommendations we've had for a while.
Right.
But
go
it-
ahead, Steve, explain this.
Yeah, sure. I guess just to explain the table, look at it. For example, I have 25 years, I highlight in yellow. What it means is that in the last 25 years, average inflation is about 2.2%. The Fed fund rate is about 2.6%, which is kind of return you will get from your savings bank. You put your money in the bank, that's average 25 years, what you're gonna get. Average 10 years yield is about 4.1%. And if we use the Rocketton's cap PE model, the expect S&P return is about 6.5% compound for the next 10 years. So I guess I just want to make a quick 3 points. I guess if you look using 100 years data, you can say the expect S&P return will be only 2%, which is kind of in the green column, which is basic to say S&P is index gonna be flat if you excluding the dividend. And if we use 50 years, which is what Rockton is using, we're getting 3.5%, which is very close to 3.4% that's in the presentation. But if we're using other data like 30 years, 20 years, we're getting to 6.5% or 6%. So it's a very wide range how many years of data we use. We're getting data from 2% to 7%.
All right, so we'll just ask Rokitan to look at it, and we'll just continue with their, and again, in the future, if you have anything, please let us know ahead of time.
This would be a hard thing to just send out because it needs an explanation.
Yeah,
right?
but to have someone who's not part of the board speaking about it is also
He's part of the board
Well,
because he's with me.
is that it?
He's a designated
We could all bring our own analysts. The meeting would go till 3 o'clock in the morning.
All right, Rokitan, I'm sorry, Robin, will you continue?
So, all right, so we've taken away a few points, and I think we are virtually done. If I
have two
yes.
more.
Yeah, oh yeah, go ahead.
And it might be in here and I've just sort of missed it, but just going back to the basket.
Yeah.
Do we have an example of your recommended portfolio and then next to an unconstrained portfolio, what that would look like?
No, but we can.
That would be great.
I have another question.
And okay, go ahead.
Oh, sorry.
No, go ahead. Go ahead.
Oh, can you explain why you increased your return assumptions for core real estate from 6.4 to 7.4, even though cap rates are lower, right? Yeah, cap rates have gone down. Isn't that what you said, Mike?
Yes.
Yeah. Cap rates have gone down, but you're increasing the assumption for core real estate? I don't understand that. I mean, what you said, Mike, I think, was that generally cap rates are the sort of predictor for for real estate returns.
Yeah, I think, we'll take that back and look into it. I would say that, I know that we are now explicitly incorporating the leverage that core real estate managers incorporate into their portfolio. So historically, core real estate funds have about, and this is represented the index that we use for core managers, the ODC index, which is open, and that has about 30% leverage in it. And I'm not, it could be that 3 years ago we were not as explicitly incorporating that, and so we'll go back and look into that, because I understand that it seems a little bit strange that the returns coming up, given that cap rates have come down during that period.
And sort of one other question is, so your return expectation for high yield goes down by 80 basis points. You're now recommending an increase of 3% in the high yield allocation. The original proposal is the wrong word, but yeah, proposal that you put out, I think in the summer, had a 0 allocation to high yield. So I'm just trying to understand where the high yield thinking comes from.
It came.
Well, I think that that came from the fact that, I mean, if we're reducing equity by as much as we're reducing equity, we're looking to replace, and we're looking to reduce risk. High yield is a way to get return with less risk. It also doesn't contribute to the basket clause like some of the other asset classes that could get us return to substitute for the fact that we're losing return by reducing risk.
Bank loans, for example, went down to zero, so there was a trade-off between bank loans and high yield.
But bank loans is basket, high yield is not.
Some of
So-
some of high yield is. Yeah,
very
yeah,
little, I think.
yeah, so we were creating basket availability.
But couldn't, again, just the, you get a much higher Sharpe ratio from OFI. And then you could take bank loan, what you had explained last time was that you were taking bank loans and putting it into infrastructure. So now you're saying bank loans going into OFI.
Well,
and
it's all
not
fungible, but if
not
you,
into OFI, into high yield.
but if you look at the combination, what I'm saying is the combination of high yield and bank loans and the current allocation is the current target is 7%. So we're raising high yield to 8%, and bank loans are going to 0. So there's a net addition of 1 in the combination of bank loans and high yield.
And high yield has the as low as the return might seem, and it is relative to what a normal return would be for high yield over a reasonable time horizon, if it were fairly valued. It doesn't take up basket clause, or it doesn't take up basket, I should say, and it offers a better return than U.S. equity with considerably less risk. It's the best among a number of not great choices. I guess that's the way the optimizer would tell us. Is that
It's
it's
just, I still wonder about the reduction in OFI, given that OFI has, I think, the highest Sharpe ratio by far of anything in your list except for, well, it's still the highest at 48.
I think that's a basket issue.
I think it's completely basket, John. So it's competing with basket assets. So it's competing with international equities, EM equities, private equity. That's where it infrastructure. That's where its competition comes from.
It's just strange to me because they all have lower Sharpe ratios. Now there may be a correlation issue, which isn't.
Yeah, and that's yes. There's a lot that's going into the optimizer, and that
But it would be
correlations are a
interesting
factor.
to see that and to say, well, what if we did it? If we put some of that into OFI? Again, we're not seeing the. I would be interested in seeing sort of the alternatives here and how they play out.
Sure.
And because it's just looking at the numbers, it's just some of it's kind of strange. It's not intuitively make sense. And you talked earlier, Robin, about how this is the optimizer spits out numbers, but then there's some qualitative determinations as well that go into it.
Yeah. So
And
we can.
It just looks like OFI, pretty high return, pretty low volatility.
So we can look at what happens if we apply a constraint to OFI and raise that allocation. So we can look at that.
Okay.
But John, just intuitively you go through it. If you're going to reduce OFI, if you're going to increase OFI, you have to take something out of the basket. That's where it's got to come from. So then you run through your options on the basket, and you can kind of not do the math in your head, but you can see the directionality of that.
Well, again, just looking at Sharpe ratio and correlation, you would think you'd be better off, and again, I realize you have to take into account the implementation challenges, because OFI, you can't just, not liquid, but from a correlation and Sharpe ratio perspective, you would think OFI would be better than either international or emerging markets. They both have lower Sharpe ratios and higher correlation to U.S. equities than does OFI. I'm just,
we'll look at that. Yes.
I want to see.
Yeah.
I want to taste the cooking, but I want to see what the ingredients are.
Yeah. The way to really look at it is because there's so many pieces moving simultaneously, and it's hard to identify all the trade-offs. But we can look at different portfolio mixes. so for example, what would happen if we changed the US equity assumption? What would happen if we forced a higher allocation to OFI? And we can also look at an unconstrained portfolio, all of the items that have been raised.
Just one other.
Okay, so I think Susanna's been waiting for
Go ahead.
One more,
Yeah.
we've talked a little bit about it, but I wanna go back to convertibles.
Yeah.
Because on all of these charts, it looks like, and I don't know if convertibles count against the basket or not, but, so they're not basket, assets, and, you know, the return assumptions and the actual returns are pretty good.
So we did include converts. So converts today have a 0 target allocation. They have a little bit of an actual allocation because it's used as a parking place.
Yeah.
But we did include converts as well as other asset classes in the original runs. And the optimizer was, I think, producing a target allocation of something under 2%, and we decided that that was a suboptimal allocate. That was too small, and we decided to move that down to 0. The other issue with converts that we ran into when we did have an allocation to converts, and you may or may not recall that Rokitama was a big advocate of converts historically, because there's some interesting properties with verbal asset class. The system had a hard time finding managers to implement a reasonably an allocation of virtually any size, and so it was a combination of two things. One, having a reasonable allocation, 3% or more to converts, was hard to implement across the system. Secondly, the optimizer, given all the trade-offs, and converts have a pretty high equity correlation, it produced a very modest allocation to it, so we rounded down to 0 essentially.
The next 10-year assumptions for converts are forecast as 3.1% return, which is close to U.S. equity, and it's driven by its link to U.S. equity.
Right.
So that's a factor that's
Right.
driving the allocation to convertibles that the optimizer gives us down, and then we took the additional steps that Robin mentioned.
Right. I would just say, you know, can we throw that back in? Because if it's either, you know, sort of in the no stone left unturned, trying to bump up, you know, sort of wherever we can, because historically, you know, there has been this outperformance of U.S. equity, and I think that convertibles are for this kind of crazy interim time in the market. I don't know exactly what to do, but.
Well, if we
And high yield too.
if we look at a U.S. equity return, which is closer to the 6% we talked about earlier, we would want to change the way we model asset classes, given that other asset classes are linked to us. We don't want to just change one asset class and ignore the fact that there are these linkages across other asset classes, which we want it all to make sense together.
Right.
So I think converts would be a byproduct of that.
Great.
But if you look at their capital markets assumptions now, converts have one of the lowest Sharpe ratios of the entire list. So it's kind of, that's intuitive as to why the optimizer with these capital markets assumptions would not go for them.
Right, and that means, that's, when you say they, remind me what that means, having the lower Sharpe.
Low Sharpe is bad.
Well, return per unit of risk, that's all it
Right.
is. So I'm gonna jump in because we have our presenter from Sustainalytics waiting. And I just wanna tell you, the last 2 pages in this deck are important, and I don't wanna give them short shrift, but we will be continuing this discussion. The next to last page, page 18, talks about how we're proposing that the investment grade fixed income allocation be structured. And importantly, the headline here is, we're proposing a reasonably significant increase in the capital allocation to investment grade fixed income, but not the duration target. So your current target has a duration of investment grade fixed income of over 13 years. You haven't gotten there, and you know that you haven't gotten there. The implementation of that has been slowed down since you approved the last target allocation. We're suggesting that you keep the current duration allocation close to what it is currently, at about 8 years, by allocating between shorter term treasury bonds and longer term treasury bonds. And the logic for keeping, not lengthening duration as we initially proposed 3 years ago, is if we reduce the allocation to US equity, the need for that level of insurance goes down. And another important factor is it's particularly unattractive to buy long government bonds today. So those two factors lead us to recommend an increase in the capital allocation, but not an increase in the target duration exposure. And then the last page, page 19, is a list of other items that will be addressed once the board has voted on any changes to the target asset allocation policy. And there's a lot of things like parking places, rebalancing ranges, pacing analyses. All of these are really important items that focus on the implementation of the policy, but you have to get to the policy before we address the implementation issues.
Robin, you were mentioning, and really this whole thing is based on modifying the decision or adjusting our choices that we made 3 years ago.
Yes.
Wasn't the return expectation 3 years ago in the sixes for the immediate future at that point in time as well? So is this?
It was like
That is a good question. I think
it was closer to say it was like 6 point.
Because
If you go to slide 5,
I have a draft where it was.
Those are actuals. Oh, no, you're right, 6.7. I'm sorry, that isn't.
So it's not drastically far off.
Right, it's 60 basis points lower, yeah.
3 years ago,
yes.
as far as our expectations were.
That's a very good point, thank you.
Well, and to that point, the funds return for the last 3 years since that study is 9.4% annualized. So we've exceeded the expectations, and that's part of the
Nothing wrong
logic.
with exceeding
That's
them.
part. No, and that's great, and part of the logic for our lower return expectations today is that we don't believe you can continue to exceed long-term expectations in the short term, and then and just continue to have that be true in the future.
You don't think we should change our assumed interest rate to 9.4%?
Probably a little bit,
Optimistic, yeah. So thank you, and this is really helpful to get all the feedback from the board, and we will be back to you. I don't know if we'll be able to be back in January, because there's a fair amount of work that we need to do, but we will be back to you as soon as possible so that we can continue this dialogue and hopefully get to a point where we're comfortable taking a vote.
Okay. Do we need a little stretch for 5 minutes, anyone, before Sustainalytics comes? You all good?
Sure, yes.
All right, 5-minute stretch, 10 to 12.
Chair yoga.
4-minute stretch.
So, should I
One
go
more,
ahead?
yeah.
Yeah, so we have representatives from
Go.
Sustainalytics, in to talk to the board about their activities in terms of engagement with, companies. And I'm gonna allow them to introduce themselves. And, I think we have, like, how much have you scheduled for this?
About 25.
So we have about 25 minutes scheduled, so thank you.
Okay, and welcome again to Teachers Retirement System.
Wonderful. Thank you so much. Thank you, Robin. So I think many of you know me already. It's wonderful to be here again. Thank you for the opportunity to speak about our engagement services. It's a unique opportunity. We have Charlotte here, who's based actually in our Copenhagen office and really runs the commercial engagement activities and is really an expert in this field. So we really want to take this opportunity to have Charlotte kind of introduce our services and help answer any questions that you might have. I think one of the things she really wanted to touch on is how asset owners in Europe are using engagement services in particular. I think that might be something that's of interest. So Charlotte, over to you.
Great, thank you. Thank you very much for having us here. I'm really thrilled to have a chance to come and speak to you. Just very briefly about myself, I've worked in responsible investing for quite a long time, coming up to about 13, 14 years. And I focus on our engagement clients, like Anya said. And that means that I'm often out and about meeting with clients and investors in general, getting an understanding for what are the trends that we see in the market and how are investors reacting to increasing legislative pressures or stakeholder pressures in general, and of course also including from their scheme members. I also work very closely with some of our pension fund clients in Europe, where I meet with their trustees, with their investment committees. We go through engagement strategies. We talk about their overall stewardship activities, so their approach to stewardship. And that also includes their wishes to focus on impact and reporting through engagement also. So that's just a little bit about myself. I don't know, you're gonna, or you know everybody already? Okay.
So I've met most of you before, so Matt Raimondo is Sustainalytics. I'm on the client advisory team, so nice to see you all again.
Okay. So I also just want to spend 1 minute reflecting on, I remember the first time I came to New York to meet with investors to talk about responsible investing. And that's about 10 years ago, and it was quite difficult to get a meeting with investors to discuss this. There just wasn't that much of an interest. We met with some of the, you can see the faith-based investor organization endowments, but otherwise you didn't see very much traction in this field. And I've just spent the past few days attending events and conferences, and when I see how that has changed, it's really quite remarkable. So I just, I attended the Responsible Investor Conference yesterday, and there were so many pension fund representatives there, and it's really encouraging to see how it has moved up the agenda. So yeah, so I'm thrilled to be here also. I was looking at, when I was preparing for the meeting, I was looking at the TRS's investment beliefs, and I see that the ultimate goal is to provide secure and sustainable pensions. Now, engagement is really about that, right? It's about long-term value preservation of your scheme members' pensions. Now, it's about addressing any of those long-term risks that are in the portfolios, and engagement is very much a strategy for doing that, right? It's, first of all, you're managing the risks in your portfolio, but it's also about embracing stewardship responsibilities. So as an asset owner, there are ways that you can really show the investment beliefs you have, and really make sure that you have an impact, a positive impact on society, on the environment, and so forth. It's also about having a link between engagement and voting, so ensuring that there is that connection so that you vote in accordance or in alignment with what you're engaging on, and vice versa, right? Because otherwise you might actually hamper the activities of the engagement program. So there are a lot of different use cases, and I just wanted to highlight some of those. We have a lot of slides here, and we only have 25 minutes. So I'm just gonna dip in and out of the deck, and then please feel free to contact us afterwards if you have any questions to some of the other slides. But I'm going to go straight to slide number 8, which just highlights the 3 different types of engagement that we have. So we call them pillars, so the engagement pillars. And it's based around 3 different approaches to shareholder engagement. The first one is around the thematics. So we call it stewardship and risk, and it's focusing on certain ESG themes, like it can be climate change, it can be workers' rights, it can be plastics and the circular economy, and so on. So we have a large number of different themes that are identified by Sustainalytics, but also by our clients. So they come to us and they'll say, here's a topic which is of particular importance to our members or our clients, and we'd like to do something around that. The second one that we have is around business conduct. So as you'll know, when you are a large global investor, there are lots of things in your portfolio holdings that aren't always so nice, actually, right? To be quite honest. And it's about being aware of that. It's about businesses' conduct. So here we're talking about violations of labor rights, child labor, it's about environmental pollution, it's about corruption, money laundering, and so on. So we gauge on the back end of the extensive research that we have in this field, right? So we identify the companies that are violating many of these standards and norms and conventions, and then we focus the engagement around bringing those companies into a compliant status where they are no longer breaching, and where we ensure that they have processes in place so that will not happen again, hopefully, in the future. The third pillar is really where we focus on very much the materiality aspects. And here it's a direct link with our risk rating, which identifies companies that are either high or severe risk, and we look at a large number of different indicators where we evaluate a company's ability to manage those risks, and then we engage on the back end of that. So just to give you, those are the 3 approaches that we see that most investors use. So it's the proactive, the thematics, but it's also about the business conduct and managing the risks. If you go to the next slide, I just want to highlight a few things about why we think that Sustainalytics engagement is a really strong offering and a really solid position. So we've been doing it for a long time, and what I mean by that is earlier this year, Sustainalytics acquired a firm called GES International, and I was part of that firm. And we were a shareholder engagement firm that had a large global client base, and we've been doing that for about 25 years. Now, we work with the likes of the Swedish AP funds that you might be aware of, but we also work with the UK's Postal Pension Fund, the Royal Mail, London Transport for London Pension Fund, and so forth. So really large pension fund schemes. And we represent almost 60 clients globally with about 2 trillion euros in assets under advice, which is quite significant when you're trying to get, Facebook to agree to a meeting, or you're trying to get Shell or BP to discuss some of their large-scale environmental issues, right? So we also have a very transparent engagement program, and that means that clients can participate in meetings, they can dip in and out of conference calls. We also organize trips. We go to a lot of different locations. We went to visit cocoa plantations in the Ivory Coast to see how child labor is being addressed. We've been to visit dams in Brazil, and clients can participate if they want in those. However, not everybody can go along to these things or might not have the resources. So we make everything available on the client platform. So you can go in and you can see, well, what letters were sent to which representatives in the company, what were the responses, what were the agenda items, and it really allows you to report extensively to your stakeholders as well. So it means that you can follow the engagements very closely, either in person, or you can also do it via reporting. The engagements are really focused on specific goals. So whenever we find an issue that needs to be engaged on, we will develop a clear strategy. So who do we speak to within the company? What is it that we're trying to obtain through the engagement dialogue? Where is it that we want to try and move the company? And then we measure very carefully what the progress is, what the milestones achieved are, and so forth. We also have a terrific team. We have 25 engagement managers based in North America and in Europe. You might have seen that Rhonda Brower has just joined the New York team. We're really delighted to have her on board and super excited because we are expanding our North American engagement presence. And so we have the team here and in Toronto also, and then a large part of the team is also in Europe. And then just lastly, it's about having a global coverage and a global presence. So we engage globally, which means that we also need to be a global firm and a global team. So we have a large engagement presence in emerging markets, where we have a dedicated emerging markets part of the engagement team. They travel extensively, probably about 150 days a year. They're currently in China at the moment, meeting with some of the quite challenging engagement companies that we have there. But it also means that they understand the context that the companies are operating in. They have the language capabilities. We are frequently in Moscow, where we engage with the likes of Gazprom and Norilsk. And you need to have that, not only the language, but also the cultural awareness and just understanding what the context is, especially for emerging markets. So just a little bit about how we approach engagement. And I want to emphasize that because I think there are a lot of different understandings of, or perceptions of what shareholder engagement is. So for us, it's really about building up a constructive dialogue. So we don't go out and name and shame to the media and so forth. We really approach the company in a constructive way, where we work together on furthering the corporate agenda and making right any wrongs that have taken place. Now, it means that we build up a relationship around confidentiality and trust. So we don't share information or responses to the wider public. It's between the clients and the company and ourselves. And we conduct our meetings in a very, you can say, mutually respectful manner, and the dialogue really reflects that very much. We, as I say, the clients can be a big part of it if that's what they want to. We also have some clients that do some engagement themselves, and then ours is done in parallel. This is in particular if some clients want to engage on their own home market companies, or if they have a specific sector that they want to focus on, and then we might do something in parallel also. Are there any questions so far? Or
can you elaborate a little bit on your success metrics for engagement? So idealistically, you are going to see some culture, behavior change perhaps, but we know realistically there's a lot of cost of doing business, box checking that happens among a lot of these offenders.
Yeah.
So how do you sift through real change?
Yeah, that's a really good question.
Procedural change.
Because I've also seen a lot of change over the years. So in the beginning, there was a term which was tea and biscuits engagement, which was literally meet with the company, a nice cup of tea, and you have a biscuit, and then you might meet again next year, and nothing really happened. There was no follow-up and no measuring. That's not how engagement is done anymore. Right? So it's really, you have those clear goals and objectives in the beginning, and then we measure progress in 3 parameters. We look at the response of the company, so how willing are they to speak to their shareholders or their investors and ourselves. We look at the progress. So are we actually making any progress? Is the company disclosing information? Are they making changes to whatever it was that wasn't right? And then the last parameter is around milestones. So we have 5 milestones in an engagement, where the first one is establishing contact, and then the 5th one, the last one is the objectives have been met and we now resolve the case. It's now closed the case. We measure that on a quarterly basis. And we're looking for real tangible outcomes and tangible impact that we can measure and that we can report on. When we don't see any progress or any willingness to interact, or it's just we're being stonewalled or they're not really sharing anything, we also have a process which is called low performance process. And that means that we throw everything at it, right? So we will exhaust all our tools. We will write to the board, the CEO. We will get shareholders to involved, and they will co-sign letters and so on. really to try and encourage the company to come to the table. If nothing's happened still, then we will disengage. And what that means is that we will stop our engagement efforts. We notify the company that now, on behalf of our clients, we have decided to disengage. Now, for some of our clients, it also means that they will exclude the company from their investment portfolio. This is in particular many of our Nordic pension fund clients. They have it in their investment policy that we can accept that there are violations in our portfolio, but if the company isn't interested in addressing them, then that's sort of that red line that they don't want to have the company any longer. So that's a little bit about how we measure the progress.
So a different question. We are working with Sustainalytics to firm up an arrangement to have you annually report back on our portfolio and do some screens. Mm-hmm. Can you describe how the engagement practice works with that practice within Sustainalytics?
Yeah, the overlay.
Yes.
Because actually the engagement is an overlay to two of those screenings, right? So, I mean, we engage on, it's called global standard screening. So the identification of violations, right? So business conduct violations. And we engage on all the what we call non-compliant and watch list companies. And there's a direct link between the two. And then the other one that that's an overlay is around the risk rating product that we have. So we engage on the companies that are either high or severe risk. So these are companies that are not managing their risks and they have a high risk already. So let's imagine an extractive company exposed to a lot of risks in that sector and they're not managing those risks properly, right? So then we would engage on those as well. So that really is one of the advantages of being a one-stop shop, as we call it, because there is that seamless link between the research. You can always refer back to the research and explain, why did we choose that company to engage on, and how does the engagement reflect, or how is it reflected in the research later on?
Right. Can you talk about that a little bit more? How it's reflected in the research later on?
Yeah. So I mean, for the business conduct where we're engaging on the violations, the goal is obviously to stop the violations and to make the companies compliant. So hopefully, after the engagement process has taken place, then the status would change to compliant, or at least to watch list. If it's non-compliant, then it's down to watch list.
So is it the engagement team that's sort of informing the research team and would cause the rating or the color or the change?
I know there's a lot of different. We have a lot of acronyms as well. So yes and no. So we believe it's quite important that each of our services has its own sort of integrity. So it isn't influencing the other services in an undue way. But what happens is that the engagement managers will, when they're speaking to the company, they will encourage them to make information publicly available. Right? So, you really should be disclosing this widely. It should be on your website. You should be sending this information out proactively and so forth, which will then influence either your rating or it will influence your non-compliant status as well.
Right, so it's more objective if it's out there, transparent to everyone, than just the team saying, oh yeah,
Exactly.
Success with this one, and you should change it.
Yeah, because we also believe that there needs to be a widespread verification of facts as well, right? So it can't just be the companies sitting and saying to us in private, yes, we're on top of that, we fixed it, here's a policy that we might be implementing it next year. Okay, no, we actually need you to really implement it, and that needs to be known to everybody. All the stakeholders need to be aware of that, and the best way to do that is to make that publicly available. So it's really about holding them accountable and making sure that there's a follow-up to the discussions that we have with them, so that it isn't just in that, that closed forum where we're discussing it. We need to really see it implemented as well.
And maybe just another thing to add, that there are two separate teams. So there's the team that is doing the research, and then there's the engagement team. So there is a separation there as well. Yeah. The engagement teams do have the ability to, of course, leverage all of the research that the research team has done, which is one of the really, I think, big advantages of Sustainalytics. The fact that the engagement managers have access to a lot of the research we've already done, but they are two different teams.
Yeah. And I should also say that the clients have access to the engagement managers as well. So let's say, for example, that you're speaking to one of your external managers that holds a problematic company, and you would want to ask that manager about what it's doing. You could look up the information in our platform and see, okay, so this is how the engagement with Walmart is going, for example, and then you could even call up the engagement managers just for a quick briefing. And then when you speak to your external manager, you could say, so we understand that, Sustainalytics has a conversation with Walmart, these are some of the problems. Are you aware of that? Are you also asking Walmart about these things? Or, it's, at the end of the day, and that's a very clear trend we've seen with our pension fund clients, they are holding their external managers much more accountable. Right? So there's really, all the way from the due diligence of new managers onboarding throughout the relationship with their managers. They're asking for much more reporting, for alignment with the pension fund's own investment beliefs and so forth. So that's one way we do that also. I just wanted to touch on a couple of...
I think there was a question.
Oh, sorry.
Go ahead.
Sure?
ask him.
Okay. All right. I just want to touch on a couple of things. And I'm conscious of time also. If you go to slide 14, just to say a little bit about what are the trends that we see, what are investors really concerned about from a thematics perspective as well. I mean, I think it almost doesn't need mentioning, but climate change is very high up in the agenda. To such an extent that some investors maybe feel that it's hijacking the agenda a little bit too much sometimes, because it is an incredibly important topic, but there are also other topics that are very important also, especially in the social area and in the governance area as well. And of course you can argue that if you have a really good corporate governance, then you would be managing many of the other aspects also. So we do have a lot of focus on corporate governance in our engagement. We are launching a theme which is all about tomorrow's board. So how do company boards manage the ESG challenges that the company is facing? How do they incorporate it into the long-term strategy and so forth? But we also focus on such things as child labor, the cocoa sector, food supply chain. So we took a number of investors to Italy to visit tomato farms and it was interesting because we brought along supermarket chains as well as the investors to visit the farmers, and the farmers to explain to the supermarket chains, we're under such price pressure from the supermarket chains that we are having to employ very, very low wage workers, which then means that there are a lot of illegal immigrants that are working on the plantations or having very poor working conditions as well. So really bringing all these stakeholders together into one room and saying, well, how do we address these across the sector? So it isn't just about, what does Walmart do? No, what do all large supermarket chains do to address this? So the thematics are very much focused on, raising standards really across different sectors. Yes, and in here, I mean, for your own sort of reading later on, there are some examples as well of cases. There's a study on, or a case we've had on Walmart for a long time. You can have a look at that as well, just to see how that engagement has been led. We have examples on the child labor in the cocoa sector, just to give you an idea of what does an engagement look like, how does it start, how do we measure it, what are the kinds of activities we do, and what are the potential outcomes of an engagement also. When it comes to the reporting, I mentioned before that we're focusing a lot on really the tangible impacts and so forth. And just to give you a little bit of an overview, last year we resolved 34 cases and we moved 48 milestones, which might not seem like a very large amount, but keeping in mind that some of these large companies take a really long time to engage with. And I think it's important to recognize that. On average, We looked at all the engagements we've done. On average, an engagement case is about 3 years from start to finish. So from the time that we are made aware that there's a problem that needs to be engaged on until it's resolved, on average it's about 3 years. So sometimes it can be faster, and other times it can drag on for a really long time. And a lot of different factors play into that. So, we'll keep you informed as we go with all the reporting, and there really is extensive reporting. We've got quarterly reports and annual reports and lots of statistics and case studies that you can share with your stakeholders as well for your own annual reporting and so on. But this is it is a patience.
Is there any follow-up after you complete a case? You go back after a year or so
and see if it's stuck to. Well, I mean, so we have reoffending companies for sure. And the way we identify it is really through our research. So if a company has, if the case has been resolved, but we will pick up another controversy or an allegation, or that the company is re-violating, then we will reopen a case again, because then clearly it didn't quite work, right? They didn't stick to the processes they had implemented, or there just wasn't enough coordination throughout the large organization of implementing it.
You said you never go to the news media.
Yeah.
Is there any case where you see something so egregious that you feel compelled to go to the news media?
No, we leave it to our clients to do it, actually. So we...
Do you recommend them to go to the news media?
Oh, I don't know what to say. It can be effective, right? I think if you have a very high-profile case, which might need a little additional nudging from investors, it can be effective for a client to go and talk to the media about it.
Big decision, I guess.
It's a big one, and it's also putting your own name on the line, so to speak, right? If you were to go and
might affect other clients,
right? So it's it's a bit. I mean, we have clients that do it, that go or at AGMs are very vocal about certain cases and so on, and if they need us to help them getting the research in order to go and speak to whoever they want to speak to, we can do that as well. But we don't. We have a lot of clients, especially pension fund clients, that don't wish us to take that role. They don't want us to speak that publicly on their behalf, if you see what I mean, in terms of naming and shaming a company.
I think another maybe interesting thing to note is that the anonymity that's possible for clients.
Yep. No, that's a good point. So not all our clients wish to be public about their names with the investors. So what we do is we contact the companies initially, and we'll say, we are here representing a number of clients, and then we would mention the clients that are happy to be mentioned, but the ones that don't wish to, we wouldn't disclose the name of the investor to them.
That makes me wonder if you, in the course, so it's a private relationship, you're hired by the investor, you go in and you discover something illegal, or, how much are you responsible for reporting to local government, to NGOs, on top of whatever you're going to report to the client?
So, we will engage on the back end of the research, and that is typically where anything illegal will have been disclosed, right? Will have been revealed, so to speak. So, we're not investigative reporters in that sense. We will go in and we will assess the processes and the management systems based on what the company discloses, or based on what is publicly available. But we don't investigate in that sense. Do you see what I mean? The difference between, so we'll see what they're disclosing or what is publicly available. I don't recall any instances where we have discovered anything illegal that wasn't already known to be illegal.
Do you have any statistics about how successful the engagement is, and also, so you engage, everything is good, we decide to invest, and then a repeat offender? Do you have any?
Yep. So, last year, 73% of the engagements had a medium to high progress, which if you remember, I said we have those 3 parameters that we measure. Yeah, so that's quite good. Things moving along definitely quite nicely. In terms of reopening of cases, I don't have the statistics sort of on me now, but I can definitely find out.
And again, most concerned with everything's fine, we invest, and then they have the problem again.
Yep, I can definitely find out. And I mean, we do have repeat offenders for sure. I mean, Walmart is one of them. And Walmart actually, it's an interesting case. You'll see in the papers that they used to be on a disengaged list as well, but then they changed quite a lot of their management, and they became much more interested in speaking to their shareholders, and now it's quite a good dialogue we have with them. They're willing to meet and go on investor roadshows and so on. So that they've done a full sort of full turnaround. But I think there is also the recognition that some of these really large companies that have massive supply chains, things happen, right? And I think there's a recognition of that, and that's really working with the company to address that.
Charles, do you ever fear the safety of the people who are going to do the engagement? I mean, I would think
it's a good question. Yeah,
it would be a little dangerous to.
Yeah. So we went last year. Our team went.
No,
we went to Zambia in Africa last year to visit Glencore mines, and we were supposed to go to the DRC as well, but we had to cancel that part of the trip because there was just too much civil war unrest in that area. So we will absolutely check with. Embassy recommendations and foreign service recommendations before we go anywhere. And then when we go to problematic areas, the company or the companies that we visit, they will set up a program for us, and their security will get involved to make sure that everybody is looked after really well. But if it's deemed anywhere too risky, then we absolutely don't go. We cancel it as well. Yeah. But yeah, I mean, we definitely have some clients that are very adventurous, that are up for going to many different interesting places, for sure.
Wow.
But obviously always with safety in mind.
Question?
Yes.
So it's not clear to me, how do you select the companies for engagement? If a client says to you, we would like you to engage with company X in country Y, do you say, sure, we'll do that? Or do you have a process for determining what your engagement targets are?
Yeah, we do have a process. So the way it works is that for the business conduct cases, we look at a large universe, right? So a large investment universe, which will follow some of the large benchmarks, and then our research will identify which of the companies in there are non-compliant or on watch list, and then we will engage on that group. For the material risk engagement, it's really looking at those companies that we have identified as being higher severe risk. So if you come to us and say, well, we have this is the universe that we invest in, we would notify you of, well, these are the companies in that universe that are eligible for engagement, right? So where we have a case, there's a violation, or we deem that this company has a large unmanaged risk that needs to be engaged on. The last pillar, the thematic one, there we look very much on client holdings. So we work with the clients to choose the companies for the themes. So first of all, we'll do a benchmark report off of a large benchmark, and we'll identify the companies that are most exposed to whatever risk it is that we want to focus on through the theme. And then we will work together with the clients on selecting 20 companies for each theme. So, and this is to ensure that client holdings are part of the theme, right? Because this is it's a 3-year, very focused thematic engagement. So we want to make sure that clients have their most important holdings in that theme.
So back to the business conduct. So if a company, and just to be clear, business conduct, you say a company that is deemed to be non-compliant or watch list, that's through the Sustainalytics rating system?
So it's the UN Global Compact screening,
UN
so the global
so a company that
standard
is
screening.
on that list as non-compliant or watch list, you're going to engage with that company. Got it. Okay.
Yeah, so we currently have about 600 companies that we engage on.
Really? That's a
Yeah,
huge-
yeah, and we're
But that's worldwide.
yeah.
Do you know how many in emerging markets by any chance?
Out of that group, about 250.
Wow, okay.
Yeah. I mean, keeping in mind, we have a lot of developed market companies that have operations in emerging markets as well, right? So the 250 are the ones with headquarters in emerging markets.
Domiciled in emerging.
Exactly, and then you have a whole other string of companies that
Right,
have operations there as well.
Got it.
And what I thought actually was particularly interesting before we were preparing for this meeting is that the two of the companies that you asked me to showcase in the case studies are actually companies that we're actively engaging with. So Gazprom and Nornickel.
Yeah.
So.
Yeah, and I mean, so Anya was telling me that you were interested in those two cases, and I can just sort of give a little anecdote about it. Our emerging markets team has gone to Moscow several times to visit with those companies, and we do the engagements in Russian. We bring along our Russian colleague who helps us translate, and it's definitely been very interesting to meet with them. And we also, if you're familiar with Climate Action 100, which is a large investor,
Yeah,
so we're the leads on Nordic nickel on that one. So we do that on behalf of AP7, which is a large Swedish public pension fund. So yeah, so we know those two companies quite well actually. Yeah. So I've tried to pick out and highlight the I think what would be most interesting for you, but please, if you have any questions or if there's anything I've missed, or just let me know.
Any further questions?
And it just procedurally, we contract on an annual basis. It's a three-year cycle time, you're saying. So how does that
just
work?
for the thematic one, just for the themes, right? So for the other engagements, you can join any time and you can leave any time, so to speak. For the themes, we ask that you sign up for the duration of the theme. So if you join in the first year, then you would sign up for 3 years. But if you join in the second year, you would join up just for the second and third year. We typically don't recommend joining in the third year because you're just joining at the back end of it, and you'll have missed out on being able to influence the companies that are engaged on and so on, right? But yeah, I mean, it's for clients that are sort of starting out, want to dip their toes in the engagement pool. It's quite nice to do a little bit of a combination of having that global compact engagement. A lot of investors call it the hygiene, right? It's there are not nice things in your portfolio, and you need to engage on that. But then they also do the thematics, right? So there's a topic that they feel is of particular importance to them and their scheme holders. It could be in the climate space, it could be in the labor rights, or whatever it might be, where you think, okay, here's something which is really close to the DNA of our organization and our members, and we want to focus on that for the next sort of 2-3 years or something like that.
I'm sorry, how does the pricing work? Maybe someone can explain that. Is it just like a straight fee and then we choose what to do, or is it like a la carte?
No, so it's relatively straightforward in that sense that you define to us, well, this is the investment universe that we are interested in, and then we give you a fee for that. And then for the themes, it's a fixed fee for on an annual basis.
For each theme?
Yeah.
I get it.
Or there's a bundled option now, so there's 4 themes.
Package.
But do we have a bundled option based on the other stuff that we're talking to Sustainalytics about?
In terms of if you're subscribing to the research and then the engagement.
Was an engagement it wasn't one of the add-ons?
No, so we hadn't provided any pricing for engagement because actually, so engagement in the US is actually it's something only now we're starting to kind of offer to clients.
And is it the same entity? It's still Sustainalytics?
Sustainalytics, yep. Yep. And actually the contracts already have language around engagement as well, as a baseline and a framework. So it becomes, let's say you did want to consider engagement down the line, it becomes an addendum to the existing agreement.
Perfect.
Okay. Yeah. And of course, regarding pricing, we of course take into consideration the fact that you are also research subscribers, etc. but they are viewed as separate services.
Okay, all right, thank you so much for joining us again, we appreciate it.
Wonderful, thank you very much for the opportunity. And again, if there's any kind of follow-up questions, we'd be happy to answer. I know there was one aspect that I noted regarding some
Reoffenders.
statistics that we'll absolutely share.
Good, thank you.
Thank you.
I'm sorry, can I just get your names?
Anya Solovyova, ANYA, SOLOVIEVA. And I believe Charlotte's name is on.
Yeah, okay.
Charlotte.
And
Matt Raimondi, it's RAIMONDI.
Great.
Thank you.
Turn around.
I'm used to the place.
Thank you.
Yeah.
All right, thank you.
Thank you.
Thank you. Take care.
Bye-bye. Okay, thanks, Robin. Do I hear a motion to move into executive session?
You do? I move pursuant to Public Officers Law, Section 105, to go into executive session for discussions on specific investment matters.
Thank you, Mr. Brown. Do I hear a second?
Second.
Oh, thank you, Ms. Vickers. All in favor?
Aye.
Perfect. Any opposed? We are in executive session. Okay, and we are back. Susan, an update?
Great. In executive session, a discussion was held about a procurement matter. Consensus was reached on the next steps. Discussion was held about a specific investment manager. Consensus was reached as to the path forward. A discussion was held about modifications to a previously approved recommendations. Consensus was reached, which will be announced at the appropriate time.
Okay, thank you. Is there anything else? Okay, do I hear a motion to adjourn?
So moved.
Thank you, Ms. Vickers. Do we hear a second?
Second.
Thank you, Mr. Brown. All in favor?
Aye.
We are adjourned.